price and value are two different things. Cheap is dear sometimes, and I think that's shaped the way I look at a lot of things.
Interesting. I managed to save up $5,000 in cash, stuck it in a shoebox, put it in a trading account, and I lost it all. Gone.
I almost wish that people's first experience in the stock market was a nosebleed like that.
Ooh, and that is heartbreaking.
When you're younger, you can go, well, I've got time ahead of me to make it back.
The younger you do it, also too, the less responsibility you likely have to others as well. So I used the tax money saved up towards the deposit about 2 weeks before it was actually due. That could have been a disaster.
Yeah, if you wait for the perfect time to get in the stock market, it's not happened yet, because there never will be a perfect time. In the meantime, everybody else is making an absolute killing.
Overconfidence. I think at the time I thought I knew more than what I did. I need to learn a lot more before I then do this again.
As long as it's not fatal, you can come back from it to a large extent. Life rewards action takers. And if you're frightened to make a mistake, you'll never achieve. You'll be a coulda, woulda, shoulda person instead of I had a go. And hey guys, question for you. How many mistakes have you made in your 20s? Maybe you're still making them. We're going to go through some of the blunders that we've made along the way and help, I guess, unravel the fact that success is learning from the things that you do wrong. As long as they're not fatal and you keep growing, you will enjoy a successful life. There's a lot to take out of this, a lot of personal stories in here of some of the crazy things that we look back on what we've done, but they're also the things that have helped shape us to the successful investors we are today. Make sure you take notes, but most importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Gee, looking forward to today, Mr. Baxter. Thanks very much for having me on the show. This is going to be a fun one for our listeners, a little different to normal, because we're going to be talking about the biggest investing mistakes that we made in our 20s. Oh. I'm still in my 20s, of course, so I'll go early on in my career, and you're certainly well past the 20s.
Well, they still hit you about as hard as Thor's hammer, to be perfectly honest with you.
That's right. Well, so maybe we can tread on a little lighter like Spider-Man maybe instead.
Yeah, indeed. Okay, so investing mistakes in your 20s, I've got to cast the mind back to that. So yeah, it's made a few.
Okay. It could be in any asset class, doesn't have to just be in stocks. And this is, for our benefit of our listeners, totally unscripted. And we're going to be raw honest here, because we have made some terrible mistakes in our time.
Should have got started in the property market earlier.
That's okay. That's
I started pretty early, but I should have started earlier.
How early?
I was in my early 20s. I bought my first place in London.
Yep.
And I reckon I should have done it at least maybe 2.5 years earlier.
And could you have done it 2.5 years earlier if you wanted to?
I think you can do anything. Okay. I think you can do anything.
But was that realistic at the time for you to be able to do it 2 years before you did?
One of my buddies, Shoes, who's been on the podcast, he got started before me. I should have started when he did. And it's not to say that, just because someone else is doing it, you should be. We've been pretty good peers and best friends for a very long time now, 28, 29 years. And I think, I should have got going about a couple of years before I did. And if I look back on it, what stopped me, I think I was probably, would have been a lack of confidence or second guessing myself or thinking I couldn't have done it. And I think, whatever you think of in life is what you get. If you think you can, you can. And if you think you can't, you're right.
Yeah, I like that. Very nice. Here's one that I made that's similar but opposite to that, is probably overconfidence when it comes to the stock market. My first couple of investments, in fact, were horrendous. Yeah. I managed to save up $5,000 in cash. And when I mean cash, I mean I took it out of my bank so I wouldn't spend it, because I was a spender back then. Stuck it in a shoebox, and when it built up to $5,000, I took it out and put it in a trading account. Had no strategy, no real plan, no nothing. And I went all in, which all in for me was the full 5, and I lost it all.
Yeah.
Gone. And that was a sense, I think at the time I thought I knew more than what I did, which a lot of people probably argue the same now, but certainly back then.
I had a not dissimilar, I can't claim this in my 20s because mine was in my teens, so that's why I didn't use it, but I had a not dissimilar dissimilar experience where I got wiped on my first stock market investment too. Yeah. And this is going to sound a really callous thing to say, particularly someone that's, a coach and a mentor to tens of thousands of people. I almost wish that people's first experience in the stock market was a nosebleed like that.
Ooh,
because it will give you a heightened sense of risk management, which ultimately long term is going to set you up for greater success, provided you don't quit on the back of that nosebleed. Yeah, was it Mike Tyson says everyone's got a plan to get punched in the face, and that taste, that acidic taste of the blood with a nosebleed is a wake up call for a lot of people. And I don't wish people to have a losing investment career. Of course, I don't. like that, but it's a really good counterbalance to people that come swashbuckling in, and they might have a really good run that's based on luck, win. Confidence is well beyond what their skill set is, and they end up costing themselves a lot of money because they go too big too early and they don't understand risk.
Yeah. Let's flesh this out a little bit more, because this is, I think, is a common trap that a lot of young players will fall into. I think in my situation, I had to work really hard back then for $5,000. You know, I was only started my career, so I wasn't paid very well. I had to save over a number of months, even probably towards the whole year for that, and then was pretty much able to lose that within the space of a couple of weeks.
Yep.
And that is heartbreaking at the time, because everything you've worked for suddenly disappears, and you think you're always starting with the best intentions that it's going to work out well. That optimism, though, is almost toxic, because it's not always the case.
So what's the gift in that? What's the learning?
The gift is that I was young. I had a crack early, which I'm thankful I did, because $5,000 back then was everything. Not so much the situation now, but the lesson is the same.
You're right.
I was able to say, okay, let's take a step back here. I actually don't know anything. I'm young. I need to learn a lot more. I need to listen a lot more before I then do this again.
What's interesting, I mean, you did a commerce degree, so this is the stuff, again, that you'd be expected to know and understand because it's covered at university, rather like I did when I did my degree. But it's not. You know,
you don't teach you how to make money from trading at university.
It's all very theoretically based, and you know, you can't apply theory in the real world. It is quite a different thing, and it catches up to you really, really quickly. But it's interesting what you say. You had a crack at it when you're young, and when we meet people that are a little bit older and they're finally getting around to doing some investing, maybe they've had a family, they've worked to get the mortgage paid down. Chances are they're coming in with more than $5,000. Chances are they've had to work, for a considerable period of time and through adversity to get that money saved up. And chances are, as you get older, your tolerance for things that don't work isn't there because you don't have time. I've tried the stock market, it didn't work. When in actual fact, what you tried was an incorrect or poor attempt at the stock market that didn't work. There are better ways of doing it, which is obviously our lane of what we teach. When you're younger, you can go, well, I've got time ahead of me to make it back. And I think that's why typically, if you looked at a financial planning process for a minute, the risk tolerance you always assume, dangerous to do it, but for people that are younger should always be higher than someone that's older because you're more guarded. Secondly, I think as you get older, because you've been up a few dry gullies in your time, you tend to be a little bit less trusting of yourself as well. You to back yourself, you've had a few scars, so you don't go charging into stuff. So when you do actually commit to it, and if it doesn't work out, it really hurts a lot more.
The age and bearishness correlation, we call that in the trading desk.
Yeah, well, he's getting older. It was his birthday at the weekend.
That's right.
That's maybe where he's come from. So
the older you get, the more bearish you get.
I'll bring him a pot of honey in for my bees if that's the case. But yeah, so I think taking some bark off early was a mistake, but it actually for me wasn't. It was in my teens. It was in the 20s. It was probably the best thing that could have happened because I was determined, and as anyone that knows me know, I'm a pretty stubborn person. I was determined to make it work. And I think that galvanized me, and it's proved to be a career now over 30 years of being in that space. So it was probably a blessing in disguise. It just hurt like hell at the time.
It teaches you a good lesson, I think, because you realize this is a big boys game and I could get really seriously hurt here.
Yep.
The younger you do it, also too, the less responsibility you likely have to others as well. So
You're right.
What about you? Any other mistakes that you made in your 20s?
Oh, yeah. Bought a car once. I bought a car once and it had been written off.
Oh, no.
Yeah, that was a good one. I needed a car. I'd finished uni and so I bought this car and on reflection, that was probably not the best decision because I didn't do a check. I thought, no, I'm not wasting my money on doing a check, and it turned out that it had been written off in an accident.
Oh, no.
So, sometimes I think price and value are two different things. Cheap is dear sometimes. And so, there's something, I hadn't thought about that for a long time. I'm just sort of thinking, okay, what other dumb, trust me, I've done plenty of crazy stuff in my 20s. Most of that will be a subscription only, let's give up type stuff. But from a financial decision, that was a shocker. And I ended up keeping that car for a while. And I'm not saying every cloud has a silver lining, but when I moved to London and I had that car and it's parked on the street, bumped and scratched and banged and until I eventually got rid of it. But that was not great either. So that set me back a little bit, and that's an example, I guess, of being I guess, penny wise and pound foolish. I could have spent a few quid on getting a check done on the car, and mark my words, I wouldn't make that mistake again.
Interesting. All right, here's one. So when I was buying my very first house. At the time, I still lived at home. My expenses were pretty low, and I was pretty tight at the time, I must admit, with my spending. And I, at the time, was under an ABN, so I had all my tax saved up, and I was meant to obviously pay that tax on time. What I decided, though, was that I was going to go and buy a house before that tax was due, because you can get finance for a house if the tax is not technically overdue, even though it's going to be due. Yep. So I bought my very first investment property, and look, to my credit, it's done really well for me, the house itself. What I did do, though, is I used the tax money saved up towards the deposit about 2 weeks before it was actually due. And then the ATO said, okay, great, we need our tax money. Then I had to go on a payment plan. And I think at the time, I probably didn't understand structuring as well as I probably should have at the time, and rushed my decision. Thankfully, it paid off. Yep. But that could have been a disaster if I hadn't timed that right.
Well, there's an interesting thing that we can tie into that too, and that is, if you want to play in the property space, you have to be up to date with your tax.
Yeah.
Okay, a lot of people go, oh, yeah, I'm a couple of years behind. You cannot be behind with getting your tax lodged. It's just basic work. And look, as a tip, I get my start, as you know, with the accountants. The first client of the year for an audit and tax done is me. I get it all done straight away because the previous year is fresh in your mind. And going on a payment plan with the ATO is not fun. Obviously, they like to charge interest for that, although you can claim that interest as a tax write-off anyway. But that's by the by. So an easy one. That's a timing issue, and it's a redeployment of funds. And you see people sometimes in a business where they've got their GST set aside for when their BAS comes in at the end of the quarter, or the pay-as-you-go, and all that stuff is stashed in there, and they kind of dip into that money to use it to run the business, the cash flow side of the business. It's not your money. It's already got a home, and it's not yours to tap into. So it's an important lesson to go, and that's why I think so many businesses fall over. They can't manage their cash flow.
Yeah, and particularly in your 20s too, and as I say, I'm still in my 20s, admittedly. You want to run super hot and super hard as quickly as possible, and my mentality back then was do everything as much as I could as quickly as I possibly could, which it is now to a lesser degree. And I'm thankful I didn't get into too much trouble, but I certainly could have.
All right, here's a quirky one for you. Furniture. I'm going to give you two stories on furniture. So my first joint in London, I'd gone all in on my mortgage, so I didn't have a lot of money.
As you do at the time, yeah.
And I remember my gas boiler had broken, and that meant I couldn't get a new mattress on for my bed, which is a biohazard in itself. And anyway, I bought this futon, and I thought this would be great because I've got people staying over. I live in central London now, and your mates all want to come up from home and all that. So I bought this futon at this furniture market. Oh, great, I got a great deal with this. I couldn't get it in the door.
Oh, no.
I used to go into my first place, and the door was under the stairs, and it was really awkward to get into. And my mum and dad were with me, and I remember it was Sunday afternoon. And my dad and I, he's got the toolkit out. He's got the door off the door frame. We'll get it in, boy. We'll get it in. And we tried every which way. It wasn't
going in.
So I ended up having to leave it out on the pavement. And that was my
free to a good home.
Free to a good home. So a couple $100 drawdown, or a couple £100 or whatever it was then. So I was pretty crestfallen about that.
Pretty dirty on that. Yeah.
I was, and there is a God in the world if you're kind and generous. And the next week, I remember there's a terrific place in London. It's called Camden Markets, which has changed immeasurably. Now it's very commercialized, but back then it's actually the number one tourist attraction in London. More people go to Camden Market than any other place in London, believe it or not.
Really? That's the strawberry chocolates I've seen.
They do all sorts of things. I think you can get a lot more than strawberry chocolates at Camden Market.
That's all I was thinking.
It's a really interesting boho place that you see all parts of the world. One of the things they used to do a lot of like antique and old furniture there, and I needed a chest of drawers to go in the room where the futon wasn't anymore. And I got this chest of drawers, and I got it home.
Will you carry it home at that?
No, in the car. The car that had previously written off in the accident.
Is a nightmare.
Yeah, so I got it at home. Anyway, I've gone through and I've negotiated really well on this particular piece of furniture, and I got it home and I was like, I'm going to give it a clean up. So I pulled all the drawers out, and blow me, there was like 400 quid in cash in one of the drawers.
Oh, really?
Someone must have left in there, or had it stuck underneath on the bottom of the drawer. It was like, how good's that? So I had a yin and yang in the second-hand furniture market over a sort of 1 week period.
There you go.
So I wouldn't say it was a mistake, but I guess The point is, think about your decisions and make sure they are actually going to work. And again, I go back to the price. I bought a futon because it was good value. It turned out to be pretty expensive, but my motivation for the deal was price, not looking at the overall benefit to it. And I think that's shaped the way I look at a lot of things.
Interesting. Well, I'll add one in my 20s with the whole car conversation. I bought a car before I bought a house, and at the time for me it was an expensive car, which now when I think back was probably a rushed decision. I bought a secondhand Mercedes, and everyone knows that keeping secondhand cars afloat, particularly when they're Mercedes, are not cheap. When you get it serviced at Mercedes, and that costs $1,000 and new tires and all that kind of thing. And I now I have hindsight. If I at the time had have understood how expensive it was to run assets, not just buy them in the first place, I probably would have played it a little differently.
It's interesting, but at the same time, the learning experience will set you up, and it has for your next car, because I know you've just traded cars, in the last 3 or 4 months.
Yep.
And what you were initially talking about versus what you've done, you went back to the learning lesson that's from that. And so I think, we're live and this isn't scripted. I think from your perspective, sometimes what looks like a mistake is actually not a mistake. It's a gain or a benefit, provided you look at it through the right lenses. And if you feel the holding cost of that car was too much and it was a mistake buying it at that stage of your life, the learning point for you is what you've done going forward, which the denominator is becoming much bigger. So over time, it's actually a very, very good investment in your learning.
Yeah.
And if someone had told you that, you go, yeah, nah, I'm wanting that. I'm gonna have that.
Yeah.
And so you have to sometimes live these things to understand why or why not to do something.
Yeah, now that I think back, I think that exact philosophy applied probably with my parents, who probably at the time could have intervened, but let me do it, only to realize I had to work out on my own that it's not just about buying the asset, it's about servicing it, particularly with property and cars and other assets of that nature. They can become increasingly expensive. So I think for anyone listening to this, if you are going to venture into a transaction of similar standard, just understand what your maintenance costs are, because they'll add up and they'll hurt.
Definitely. Very good.
All right, you got another one for us?
20s, installment warrants. There you go.
Installment warrants?
Yeah. They're
Do share.
You might find those sort of back in the museum next to the Sonic Discman and the iPod and everything else. So I came to Australia in, 98, 99, and I was trading from home, .com boom bust, it's all good. And the online market for trading here was not evolved, because the internet in itself, you would be on the line.
This is a long time ago.
Yeah, so this is where you pull the cord out the back of the phone and whack it in the computer to get on the line to do your transactions. And, it's when you look at it, it's laughable now, but that's what it was. And so the ability to trade derivatives in the Aussie market was not that evolved. You could trade the SPY, which is the share price index, as opposed to the SPY the S&P 500, in the futures market, which was still clunky. And I'm pretty sure the Sydney Futures Exchange was still open outcry at that stage. And then the options market wasn't that deep. It was, so my preference, as always, is the options market. I like options as a thinking man's derivative, but I couldn't get what I wanted. So the warrants market was the thing that was on the charge. And I remember Soc Gen, with the French investment bank, were the people that were really pushing through this. There's a new product in Stormwater. So great, here we go. I can trade these. Nice lot of leverage. Because you could put a deposit down and you could trade them over a period of time. And I thought, this is going to be a smoother way for me to get leverage exposure. Really a liquid market, shocking. And I took a bit of bark off as I was transitioning into learning more about the Australian market and trading it. And again, that's probably why I trade mostly the US now.
Interesting. Yeah, I think that's a common trap, isn't it? The over-leverage conversation.
Yeah, and it wasn't really so much the leverage. I could handle the leverage. It was just a really clunky trading instrument.
Yeah.
So what it should have been versus what it was, and as I say, ASG were probably the cornerstone of pushing that product into the market, which for retirement, for superannuation is a great product, because you could use them in a self-managed super, for example, and you put a little bit of money down and you pay the installments, and eventually you end up with a full issue of the shares was the way they work. But the idea would be that, well, if you put a little bit of money down and the value of the shares go up, then the value of what you've put down is also incrementally moved up. So it's a bit of a leveraged instrument. But because it wasn't that heavily traded, as I discovered, and you're dealing with a market maker that's the product issuer to a large extent.
Oh, no.
You got
double whammy.
Oh, yeah. It was, you got a spread you could drive a truck through when you're trying to trade them. But
Ouch.
again, that's something I learnt the hard way. So, yeah, that was, there's a couple of different chapters of my 20s that.
Yeah, me too.
Yeah. Other regrets, probably decision making, probably not going to see Oasis when they were a lot cheaper to get tickets.
Yeah.
in a week or so. And a couple of grand for a ticket as opposed to what would have been $50 back then.
Well, here's a really out of the box. I'm not going to call it a mistake, but I'll call it a pathway that I took. I really only started traveling and seeing in the world when I turned 25. And for me, that was my goal to get to 25. I had things to tick. And then it was like almost life started for me. One investment I wish I made slightly earlier in my life was with travel. And I say that because in your 20s, you never get the time back. You're young, your responsibilities are very limited. I wish I had have invested in that area of my life a little bit more. And if it cost me a month or two on the investment side, slowing down, okay, so you miss a month of investment for that, I think it's a trade-off I probably would have taken if I had to look back.
I'm glad you didn't.
Okay.
And I'm just going to throw a spanner in the works
yeah. Okay.
because what you're looking at it through is the lens purely and simply on the investment side, which is, I guess, we're the Money and Investing Show. We're supposed to be talking about investing. But had you have traveled in your earlier 20s, the type of travel and the motivation behind the travel would probably be quite different.
Agree.
Than where it might be now. You're in a serious relationship and you're traveling in a certain way to see things for different reasons. And yeah, it might have set you back a month or two in your investing career, but I think it would have taken years off you in terms of your momentum.
Okay.
Just as a personal observation.
Interesting.
Because you've basically had your head down and grinding for what's now 8 years with me. And you've done a really good job of that. And if you took the foot off the gas, say 3 or 4 years ago, to say, right, I'm going to go and do a month in Ibiza or whatever the thing may have been.
Sounds like fun.
Yeah, I have done that. I can speak from experience.
Sounds like fun.
It's a treacherous path.
Oh, yeah.
And some great experiences. But taking that time out in a more hedonistic form of travel than that which you do now, I think you would have found it quite hard to come back to the monk-like discipline that you've had over the last 7 or 8 years. And as a consequence, where you actually are now is a byproduct of the compounding of that 7 or 8 years of having your head down without distractions.
Yep.
Now you can have some color, and it's not going to be a distraction because the machine is working.
Yeah.
And I think that's really important to acknowledge it. And financially, it might be a couple of months, but it would have been devastating for your momentum.
Interesting.
And further to that, if you look at it in a slightly different lens, it's like taking a gap year. If you take a gap year, full well, you go to uni with people, and I saw it firsthand when I was at university, I'm having a gap year. They never come back.
No, never. Not in the same way, at least. Never the same. They've often in that year gone on a spiritual journey, got a few tattoos.
I feel better for it nowadays. No, you're not. Your ability to learn has changed. Your motivation's not as pure. You've looked into the abyss and quite like what you saw. Whatever it may be, and that momentum is gone. And momentum is crucial because when you've got momentum, things are easy. When you don't have momentum or you've got to restart it. Best example for anyone listening to this is think about your car. If you pull over, you see someone on the road and their car's broken down and you try and give them a hand to get it going. You hop out, you start trying to push it. Assuming they've taken the handbrake off, it's really hard work to get the car moving. But once it's rolling, it becomes quite easy. In fact, that's when all the other helpers usually pull up to give you a hand as well. It's already got momentum, but starting it from scratch or stopping and restarting is so difficult.
Yeah.
So I wouldn't, again, and it's not to correct, because I can't correct your view of the world, it's your view of the world, but to give you a different perspective on it from my side of the fence.
Good advice.
I don't think the car was a mistake, and I don't think not traveling was a mistake either. I think in both instances, they've set you up for where you are now and where you're going.
Interesting. Well, thank you for sharing it. Thank you for the insight.
There you go.
Before we cap off, any broad mistakes? I mean, we've traded blows here, and thank you for sharing some of your mistakes. Hopefully you've got benefit out of mine as well. It's funny how similar they are. Any broad mistakes that would be worth bringing up that we've seen a lot of the time early on in people's career in their 20s?
I think that the loss of momentum is a key thing.
Yeah.
And I think the loss of, how can I put this, the loss of optimism as human beings, we all need optimism. The future is going to be better than the past. That's why the stock market goes up, because typically, investors are more optimistic about the future. I think one of the big challenges for people, they get started on the money journey and they look at the housing market moving further and further away from them, so they give up. Now, that's a really big thing to give up. Oh, we're of that generation where we won't bother. No, that's the story. And yes, it's hard, but you have to pay the price for admission. You need that real asset that you just simply have to have, because once you've got something and you've got your toe in the market, and it may not be where you want to live, it might be an investment property somewhere that you can afford, which it probably should be. That's the key thing. So that's a big mistake. I see a lot of people, they just go, stuff it, it's too hard, I'm never going to get there, so I'm just going to not worry about it. And you can't do that. You've just got to find a way to kind of make that happen. And unfortunately, with some of the changes for first home buyers that we've seen come out from the most ludicrously stupid government when it comes to financial management, is going to be a death sentence for many young people with what they're doing by making it supposedly easier to get into the property market. It's going to have the opposite effect. So that's a big one I see from a lot of people. They just give up on that. Oh, I'm never going to get there. I'm just going to have to wait till, I come in with an inheritance and then I'm a chance. You got to just roll the sleeves up and make it happen one way, shape or form.
Yeah. I think on my end too, I think early in their 20s, I see a lot of guys not understand what they're doing, where they're just buying and selling assets that they haven't done any research on. Crypto is a good example of that. We know Bitcoin, we know Ethereum, there's the major coins, but all these micro coins that are floating around too. I've seen people make great money on them, and I've seen people been royally stitched up. And that overconfidence, it's a crypto coin, I'm going to buy it and have a crack at it, take on leverage.
Well, just like all stocks go up, right?
Right, smash it out of the park. It's not the case. So what I would urge is that you always do your homework before any investment, big or small.
Yeah, be curious, ask questions, find out about it.
That's right.
I think it's a huge thing. And look, you're going to carry on making mistakes. I think the key thing that to take out of this kind of conversation is, as long as it's not fatal.
We'd hope not.
Right, as long as it's not fatal, you can come back from it to a large extent. Okay, there are other serious things you can do that are hard to come back from, but don't be frightened of making mistakes, because as long as you learn from it, and John Maxwell, wonderful author, failing forward is a really good proxy for that. If you make a mistake, as long as you've learned from it and you've advanced where you're at, maybe not financially, but certainly knowledge-wise, you're in a better position than when you started. So, to an extent, everything you do is for a profit, either in the literal sense or as spelling it slightly differently, a prophetic way of learning, and it becomes a learning experience for you. But if you're frightened to make a mistake, you'll never achieve and you'll never do anything. You'll pull the shot. You'll be a coulda, woulda, shoulda person instead of I had a go and it was a bit hairy, but I got there and made it work. And that spirit that we have as human beings to keep moving forward and not second guess is crucial. If you put more pressure on yourself by going, can't afford to make a mistake. And this is where I think, if you're a perfectionist, for example, you become a procrastinator and you put things off. If you wait for the perfect time to get in the stock market, it's not happened yet, because there never will be a perfect time. In the meantime, everybody else is making an absolute killing where you're sat on the sidelines and missing the game. It's the same in property. I'll wait for the perfect property. Oh, there's going to be a pullback. Interest rates are changing. They're moving on stamp duty. There's an Olympics coming to Brisbane. There's a rental crisis. There's immigration. Forget about all that stuff. Just get started.
Yep.
And it will work out. And if it doesn't work out, you'll learn a heck of a lot as to what to do next. But if you second guess yourself, if you wrap yourself in cotton wool and be frightened to do anything, then you'll never achieve anything. Life rewards action takers. And if you're someone that takes action, you will make mistakes along the way. As long as they're not fatal and you learn from it, you're moving in the right trajectory.
I think that's where we finish this. Thank you very much for your time, AB.
Absolute pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.